Fourth question. Should be 4. Yes. Again, it is having one good point. Modern Enterprise Limited is considering a purchasing of new computer system for its R&D division, which would cost 35 lakhs. The operation and maintenance cost, excluding depreciation, are 7 lakhs per annum. So the cost is remaining same per annum. It is estimated that the useful life of the system would be 6 years, at the end of which it will be having a scrap value of rupees 1 lakh. The tangible benefit expected from the system in form of reduction in design and draftsmanship cost would be rupees 12 lakhs per annum. Besides, the disposal of the used office equipment and furniture initially is expected to net to 9 lakhs. Capital expenditure in R&D is 100% write-off for tax purpose. Now, this I will give you an overview, but it will be much more clear once you do your taxation. If you are purchasing some machinery in research and development, then depreciation will not be allowed year-wise. Say if the useful life of machine is 10 years, depreciation is the cost of machinery, will not be allowed in 10 years. It will be allowed in first year itself. So you will be getting deduction of that depreciation from your income in first year itself. The gains from the disposal of the used asset may be considered tax-free. Sale on asset, capital gain should be considered as 0. The tax rate is 0. The company's tax rate otherwise is 50%. Cost of capital is 12%. So I'll be discounting it at 12%. After appropriate analysis of cash flow, advise the company of the financial viability of the project. Alright. So what we are trying to do, try to concentrate, we are research and development department. Normally, right now, how we do our drawings, we might be some architect company or some drawing company. We are having furniture and we are having draftsmen who paint manually. They don't paint, they don't do it in Corel Draw or any other software in your computers. They draw it manually. You are planning to purchase a new computer system. Now the draftsmen will sit on that computer and will do the drawings. Okay. Try to concentrate. What would be costing? New system would be costing 35 lakhs. It is estimated that the useful life will be 6 years. All the cash flows are same, so I can do 1 to 6 years. At the end of which scrap value will be 1 lakh. So this will be at the end of 6th year. The tangible benefit expected from the system in form of reduction in design and draftsmanship cost would be 12 lakhs rupees per annum. So what will be cash inflow? 12 lakhs rupees. Besides, the disposal of the used drawings and office furniture initially is expected to rupees 9 lakh. Try to understand the situation. The question will be much more clear. It will be easy to solve. You are now removing the manual system of drawings. Now you will be using computer for drawing. So your draftman, number of draftmen will decrease. Now you will require less number of draftmen. Your design cost would decrease. And that would benefit you by 12 lakhs rupees per annum. So because you are purchasing new computer, instead of that manual system, it will be 12 lakhs rupees benefit. Reduction in cost is same as cash inflow. So this is my benefit. The operation of the maintenance is the 7 lakhs per annum minus operation cost is 7 lakhs per annum. So 5 lakhs rupees will be profit before tax. Sir, depreciation, I will not be considering depreciation. I will be considering depreciation separately. I told you, you will have to learn both the methods. Depreciation is not important. It is added, it is deducted. What is important is the tax benefit on depreciation. If you remove tax, there is no point in depreciation because depreciation is a non-cash expenditure. So I will be treating depreciation separately. Minus tax rate is 50%. Profit after tax or cash flow is 2,50,000. Profit after tax or cash flow is 2,50,000. Let me draw my cash flows. 1 to 6 years, 2,50,000. At the end of 6th year, I am getting a scrap value. So at the end of 6th year, I will be getting scrap value of 1 lakh rupees. Sir, now the machine is 100% depreciated. Whether I should consider capital gain? No, it is directly written. It should be considered as tax free. So capital gain on sale of that asset will not be coming. Other all points practically I have taken. All right, I can find out present value of cash inflow. Present value of cash inflow. Sorry, depreciation is pending. We need to consider depreciation. Sorry. All right. Depreciation we are considering separately. What is the cost of asset you have purchased? 35 lakhs. Normally, how depreciation is available, try to concentrate. Income tax department will say that your machinery comes in 10 years period, and so you deduct 3.5 lakhs every year. Believe me, in Indian income tax, it is totally separate. There is a block of asset and you will have to provide depreciation in block of asset. SLM method is not even applicable in Indian system. But this is true. Research and development machinery are allowed at 100% depreciation. So what is the normal concept of depreciation? That this cost will be allowed by income tax department in a phased manner. Year 1, year 2, year 3 up till year 10. But as this machinery is research and development machinery, it will be allowed as expenditure in first year. So whole of the expenditure will be allowed in P&L account, your first year. So it will decrease the profit of first year by 35 lakhs and there will be reduction in tax or tax benefit. How to find out tax benefit? Depreciation multiplied by tax rate. That is 17.5 lakhs. When it will happen? At the end of first year. Tax benefit will happen at the end of first year. Sir, what will be second year depreciation? 0. Third year depreciation? 0. Fourth year depreciation? 0. Fifth year? 0. Sixth year? 0. What is first year depreciation? 35 lakhs. Full 35 lakhs depreciation is allowed for research and development machinery. Sir, how it can be allowed? That is a taxation point. That is a different thing. When you will be learning taxation, you will understand it. But at the end of first year, I am having tax benefit on depreciation at 17 lakh 50,000. I will have to find out present value at the rate of 12%. First present value is very easy for you. 1 divided by 1.12, 6 times is equal to GT multiplied by 2,50,000. 1 divided by 1.12 is equal to M plus 1, 2, 3, 4, 5, 6. MRC multiplied by 2,50,000. It is 10,27,851. 10,27,851. This is to be discounted sixth year, 1.12 raised to 6. So how this will be discounted? 1 divided by 1.12 is equal to 6 times. 1, 2, 3, 4, 5, 6. Multiplied by 1 lakh. It is 50,663. And this is at the end of first year. So 1 divided by 1.12 multiplied by 17 lakh 50,000. 15 lakh 62,500. 15 lakh 62,000. This is present value of cash inflow. 10,27,851 plus 50,663 plus 15 lakh 62,500. 26 lakh 41,014. Is present value of cash inflow. All right. Important point, present value of cash outflow. What is the purchase price of machinery? 35 lakhs. Please concentrate. At the end of 0 year, you'll have to pay 35 lakhs rupees. Please concentrate, as this is the first time of this type of question I am explaining you in detail. What decision you are taking? Sir, I am taking a decision whether to purchase computer or not. Agreed. Then you will be paying 35 lakhs rupees because you will have to purchase the computer. So then your cash outflow is 35 lakhs rupees. Believe me, this is not what we are taking. What we are taking, try to understand. We are taking this decision. Should we replace manual system by computer? What is the decision? That there is a difference. Whether to purchase my car and to replace my car is two different decisions. The cash flow will be different. Should we replace manual system by computer? This is the question. And believe me, there you will not pay 35 lakhs rupees. Why? If you replace manual system by computer, you will have to purchase computer. Agreed. But you will sell your manual system. Replacing manual system by computer means selling of manual system and purchasing a computer. When you are selling your manual system, besides the disposal of the used drawings, office equipment and furniture, these are no longer required. Initially is expected to net 9 lakhs. So if you sell this all furniture today, furniture is now required, not required, not required. We have removed manual system. Then 9 lakhs rupees I will be getting. So net I will be paying 26 lakhs rupees only. Please understand, 35 lakhs is a cash outflow to purchase machinery. What is 26 lakhs? It is a cash outflow for replacing the machinery. That is selling old and purchasing new. Right now you are taking this decision, your cash outflow will be 26 lakhs and not 35 lakhs. So I will deduct present value of cash outflow as the 26 lakhs. I will be having a positive NPV of 41,014 rupees. I will accept the proposal. See, some student writes this. So we should purchase new machine. If I am a paper checker, I'll cut your half marks. What should be written? You should replace your old system by new computer. What is your old system? Manually drafting the drawings. Now what is your new system? Computers. And what is the decision? You should sell off your old system and purchase new machinery. So you think that it is a question of purchasing machinery. No, the decision making is replacement of machinery, and this should be absolutely clear to you. 5.1.4. See, when I was a student, I used to do this. I expect you also do this. What is two most other all things are routine. What is two most important point in this is this depreciation and present value of cash outflow. Other all things are simple. These 2 points are extremely important. Depreciation is not on yearly basis, it is one time. And present value of cash outflow, we have deducted that 9 lakhs rupees. Both points are good, extremely important.